But here is where the wheels fall off, and here is where trend following becomes really fun. And at a high level, trend following, you never grab the absolute top. You never buy in the absolute bottom. But here's what the beauty of trend following is, and the beauty of this trend roadmap is if we go from 2000 through 2001 through 2002 through 2003's low, oh my goodness, the NASDAQ lost 78% from peak to trough. I mean, talk about an absolute disaster. This is pretty much utter and sheer devastation of what was once the internet boom to a complete mess. And we're going to dive into the weeds. Welcome to Trends with Friends. I'm Scott Bennett with the great Mike Olafson. There was a chance that Mike was going to be on late, but he couldn't help himself. He's here bright and early. It is August 21st, back to school season. We have a lot to cover. So last week we covered the kind of the AI boomer bust, and we are the furthest thing from fear mongers, but we talk about having a plan. That's the most important thing. Following rules, having a plan, having a system. So when noise hits you, you know what to do. So we follow the trend, we follow big money, we follow risk management rules. Today we're going to dive even deeper on that subject. We're going to look at the dot-com mess back in the 1999 2000 range and how did the trend roadmap fare and kind of what to look for, what to expect. And then we're going to cover today's markets, we're going to cover trends, we're going to cover our moves. It's going to be jam packed with Invest with Rules. Let's share some screens. Here we go. Let's do slideshow. And now we're cooking. So again, welcome to Trends with Friends. Before we dive in, we're going to cover the world's quickest disclosure. This is just information. It's not a direct solicitation to go buy or sell anything. Please always do your due diligence, manage your process. You know the dance. I haven't said that in a long time, Mike. Do we need it or no?
No, I missed it, so I'm so glad that you added that in. It's made my Friday.
Thank you very much. Okay, so this is Trends with Friends. This is the perfect venue to ask questions. We review tickers. We have always kind of a fun subject in the chat at the bottom. If you're on live, thank you for being here and for your time. Just put your question in the chat, submit a ticker. If it's not during this time period, we'll kind of push it to next Friday's call. If it's something you're like, I need to get a hold of this ticker tool, it's hello@investwithrules.com. If you're like, this is totally awesome, I just don't have the time and the discipline to follow the trend, to follow big money, to follow risk management rules. It's easy when the market's easy. It's not so hard when it isn't. Reach out, hello@IWR Advisors. There's never any pressure. We have trend following strategies. We share what's called the stock and ETF trend roadmap strategy in this newsletter so you can see exactly what we do and why we do it. So today's main topic, last week we covered the AI boom or bust. If you'd like, in the members area under market updates, you can check that video out. We talked a lot about the elements of a bubble. And today what we're going to do is talk about a very big risk that we all face called sequence of return risk. It's when on earth do the bad years come? And this chart came from an insurance company because they love to freak us all out. But what they're really doing, which I thought was super interesting, is they started the horse race of your retirement right either before the boom of the dot com or right into the crash of the dot com. So it's kind of an interesting phenomenon. And they use a kind of a status quo $500,000 invested assets and you're taking out 6%, so 30K. Obviously, if you're losing a substantial amount of money in the market, it's always worthy to review your withdrawal rate. That's important. But you'll see on scenario A, you begin withdrawals in 1998, and you have two booming years in the market of the S&P 500, and then you have three miserable years in a row. And this is a lost decade, then soon followed up by the 2008 disaster. And you see the returns of the market. And in scenario A, there is a shortfall of, even though you're getting an average rate of return that's pretty substantial, call it 8%, you're out. And then if scenario B, the world's worst case, this is the true sequence of return risk, you retire right into 3 years of a dot-com crash. And this is like the worst thing in the world is like having to go back to work. So, Mike, before I jump into how to apply this to the trend roadmap and why we do what we do, why are we here today? Were there any things that you were shocked by or things that were, because I know you were kind of going through in your head doing the calculations, but anything stand out to you, Mike?
Yeah, exactly, Scott. I mean, yeah, when you and I are prepping for this and we were reviewing, especially scenario A, scenario B makes sense. You're basically starting at exactly the wrong time and look how quickly you run out of money. But scenario A, good old fashioned buy and hold at a good time, starting at a good time. I was really surprised that you still ran out of money by 2023. And so during that time, the S&P, roughly speaking, has returned about during this 25-year period, roughly about 8.5%. You're taking out 6%. So logic would dictate that, hey, I shouldn't run out of money. But because of some of the devastating drawdowns that the account took, like you just take a look, for example, 2008 losing 38%, those types of buy and hold drawdowns have a pretty devastating effect on the account where you run out of money in 23. So I was really surprised at that until we actually worked through the numbers.
Yeah. And again, if you want to dive deeper, these slides are in the members area, so you don't need to memorize any of this stuff. And we kind of share down in the corner the link if you want to check it out. Again, we have no affiliation with any of these people. We just want to say, okay, well, is there a better way? And what's the way and how we operate? And we use what's called the trend roadmap. And the trend roadmap is a sophisticated algorithm that looks at price, momentum, and relative strength. And what it's designed to do is to codify every stock and ETF, or really anything that's a moving ticker. And are we in a green gas signal, short-term, long-term uptrend, which we want to deploy as much of our money here as possible? And it's also good to know when the markets are like this. In this particular strategy, we are exiting the side door on a confirmed coast. Day two coast, below our stop, we are gone. So does that include more trading? Of course. So if trading's an issue, we in our advisory we use a longer term signal, which is called our break signal, short term, long term downtrend, where we need to be buying as low as possible, and we need to be making sure we don't sustain very horrid bear markets, which we're going to look at in a second. So we need, no matter what, for anybody, having a mechanism, a process to avoid short-term and long-term downtrends. And it's interesting. You'll see like a good example, like gold is now back in the green area. It went yellow and we're back to green. And Bitcoin, which is on fire the last 2 days, is on a U-turn. And we'll look at all that later as we progress. So we're going to start with the 1999 boom. And what we're looking at is right here on this gas signal. The dash line is the 200-day simple moving average. The green dash line is the 21-day exponential moving average. The red line is the 50-day simple. We share these because a lot of you have them on your charts. So, hey, why not put them on ours? But our algorithm shows the gas signal started in November of 1998. And you see this massive gas signal that had some coasts. So the long-term signal hasn't come for ages. But from this gas signal until we reach the absolute top, which you never know when the top is, it was 198% gain in the 1999 boom right here. So I'll adjust this slide later, but as you can kind of tell, 1998 to 2000, this is the boom area, and you see all the greens and yellows, and life is great. You'll see how these red downward momentum arrows tend to show up when you have these pullbacks. And when the pullbacks are over, you'll see these green arrows on top of that green backdrop. That's our positive momentum. We're looking for kind of that interfractal confirmation. A great example is you'll see that the red arrow left, and here it is over here in November at the final boom, the final run. And it kind of lets you grab a huge ripper of a return here after a consolidation. So we'll move to the next slide. But Mike, any comments on the 1999 humongous boom from that gas signal to the top?
No, I think you're covering it well. The only thing I will say, it's kind of funny that this brings back memories. I think there are probably many of us on the call here, the video that lived through this time period. And this is kind of my heyday of learning the stock market. So it was a wild period, no doubt about it.
Yeah, and again, if you have your TradingView Invest with Rules indicator, amazing. If you don't, go to investwithrules.com/ticker tool. If you're a member, you'll be able to log in and figure out how to just add it to your chart. So I hope that's helpful. So here, and interestingly enough, this is, I don't know if I made this crystal clear. We're looking at the NASDAQ. So the NASDAQ is what we're looking at, even though on that previous sequence of return, we're looking at the S&P. We did want to make this a little different than last week's video so you can kind of conceptualize the hottest parts of the market and what can come at some point. And what does the trend roadmap say? So now we're getting to the 2000 top. We had our very last gas signal with confirmation where I'm pointing to December 1999, and now you're in the 2000s, and here's your February 2000 gas signal with confirmation. You had your final run up, you have your overheat orange boxes, and then the red arrows start. The red negative momentum start, and you had a 1 day coast. We would have stayed in it. You had a second day coast. Um, and actually, that could have been our exit here, right, Mike?
It could have been. It could have been.
Yeah.
It's so hard to go back in retrospect where it's never going to be exact, but it could have been.
Yeah, I actually think we were up here when the day opened. Again, I was looking at all the prices and numbers. So I said this is probably the clearest version of
Yeah.
problems. So whether it's here, the average final last trade would have been around-ish 10%, give or take. Again, this is just we're looking at past signals with past hypothetical trades here. When we do back testing, it's a little bit more concise, but we're just looking at it with eyeballs. So then you'll see that you're in the 2000 top. I drew this kind of magnet. That was your top. And then you had coast signals that were sustained, downward red momentum arrows, and you finally got your break signal that came in, that's May, another big one from May into June, and then the market's trying to hold that 200-day simple moving average. And our signal does not use the 200-day simple, but we show it there for context. So now we're in the 2000s double top. Obviously, you don't know it's a double top, but it's important to see what the trend roadmap would have done. So now we're pulling forward, and you had your break signal, and here's your gas with confirmation. And then when you're in the cockpit, yeah, you just take the trade. And it would have been choppy and made a little bit of money, and then it kind of rolled over, and that would have been your exit for pretty much a flat trade. Market had one last push. We had a gas with confirmation and another final ride up to the almost near exact double top, and we would have exited for a very small loss. And here is where the craziness starts to come. So again, is it fun to have a choppy environment? Never. The last few weeks have been pretty choppy in the market in 2026. But here is where the wheels fall off, and here is where trend following becomes really fun. And at a high level, trend following, you never grab the absolute top, you never buy in the absolute bottom. But here's what the beauty of trend following is, and the beauty of this trend roadmap is if we go from 2000 through 2001 through 2002 through 2003's low, oh my goodness, the NASDAQ lost 78% from peak to trough. I mean, talk about an absolute disaster. The S&P wasn't as bad as this, but this is pretty much utter and sheer devastation of what was once the internet boom to a complete mess. And we're going to dive into the weeds. But Mike, any comments from the double top to the dot-com crash?
No, no. If you just stop on this slide for a second. No, yeah, that one. Stop there. Is it possible in that gas signal in the early 2002, there might have been a bite of the apple to see if that gas signal was taking? Of course, it's another small loss. But the point is, these small losses are nothing compared to the devastation that a buy and holder had in the queues during this time period.
Yeah, and it's hard to like feel it, but when a client, and I know this from the back end of this experience and forward into 2008's issues, 5 to 10%, it's painful, but not a big deal. It's not fun, don't get me wrong. But the moment one starts to have a 15 to 20, 25 to 30, it's uncomfortable. It's this is when people stop looking at their statements. It's when you become irritable, bleeds into your life, into other areas where it really shouldn't, and you're seeing all of these years of hard work just get wiped away. And buying and holding, if one is super young, That's nothing wrong. These are the best opportunities to accumulate as many shares as you can. But why not, if you have a mechanism to tell you when you're in trouble, like you don't want to lose your nest egg. So let's go through. We're going to now look at, we're in the kind of the middle here. We're looking at this green areas right here. So there were some chop because that's just the reality of it. So you would have avoided all of this. You had U-turns and brake signals. We're waiting for those gas signals is what we're trying to do. If one is a super fast trader, these U-turn signals can be really profitable. But the moment a brake signal reappears, you just want to kind of get out of the way. And you never totally know when the low is, but there's times where you just get stretched and you get these huge recovery bounces or reversion to the mean trades. So the first one, let's look at, we're going to kind of squint our eyes, and this first gas signal is on an overheat. So would we have taken this trade? No. This second trade in 2000, in January. It's a fresh new year. This market stinks. Maybe it's over. Maybe the follow through day comes. We would have taken it. And you would have had a couple days of profit, and then it rolled right back over for whether it's I said at the worst, a 5% loss. And then it totally fell apart. And then you had one last ditch effort. And again, I'm assuming the worst. Our stops will probably be relatively tight. Again, this is solely on the NASDAQ. Just to be crystal clear, there were other parts of the market that were going up during this time period. And this would have been another kind of a negative to flat trade, depending upon when you took it, because it went right from gas right back to U-turn. And then I said, okay, well, this is where you'd likely call mercy at a 5% loss. So, Mike, any comments on trading in the chop? And then, but the beauty is, look at how much devastation you avoid as 2002 rolls in and 2003 starts. Any comments on the chop?
It's the simple adage: keep your losses small, let your winners run, and avoid this kind of devastation. So it's just classic trend following.
Yeah, and we're showing this. It provides me context. It provides me confidence that if things get awful, that this doesn't need to be a part of your life. Can you get a couple hits where all of your neighbors and friends are down half of their wealth? Could you have some small losses in efforts to try to make a huge return? The question is if you keep your losses small, as Mike just said, you can make this back really quick with one good run. And finally, almost 3 years later, April of 2003, we get our gas signal with confirmation that is a little spooky, but it's only about a 2 to 3% pullback. And if one wanted to use this one, they could as well. But from the gas signal that never turned into a break after this point, you would have come up all the way to the top for about a 55% gain, made up for your small little losses, and your portfolio is relatively intact. So that is crazy, but that is how the trend roadmap would have handled the boom going in, whether you're a short-term trend, gas signal, sell on coast, or if you're a long-term trend, gas signal, sell on break. You can kind of see how the very last tip-top trade, you would have had a small gain, some small losses along the way, some flat trades as the double top formed. You would have avoided a massive amount of problems. This isn't perfect, but this is really helpful. Two choppy trades where small losses occurred, and then the tide opens, the river's there for you, and you have it. You're back to the devastation is over of the NASDAQ bust. Any final comments on the trend roadmap, Mike, going through the dot-com mess?
Well, Dennis in the comments had a great comment. He says, I had been with Merrill for almost 30 years. At that time, when two rookies approached two senior brokers and said, you old guys don't understand. It's a new paradigm. We looked at each other and just shook our heads and smiled. That was March of 1970. So it's always different, right? Everybody thinks that the next, but we talked about bubbles last week in general. Everybody says it's this time it's different, but is it ever different? Does the market ever change? So great comment, Dennis.
Yeah, I like that. So let's pivot to right now. So we have an issue where interest rates are going up. We have an enormous amount of debt. Is this time different? Probably not. But the debt is huge. The refinancing is huge. The risk of the interest rates increasing to the cost of paying the interest on the debt is now more than our defense spending. So the $2 billion bond operation to, in essence, buy long-term debt went to 4 billion. And the bond market so far has liked this. The precious metal markets liked it. Bitcoin's liked it. Everyone's liked it. But what's really interesting is the likelihood of raising rates went to 34%, hovering around 35, 36 today. So far, the market is happy that we didn't have a highly escalated interest rates, which will suck the life out of the equity markets. So that is really, really positive. We can look at the charts in a minute, but here's the S&P 500 still on a gas signal, pulling in from its highs. So sorry for my mouse snap there. These are the highs from the end of May, June. We broke out of this consolidation range at the end of July. July was pretty rough for AI stocks. And you had a breakout with kind of a gas signal with green confirmation. It's been chopping around this trend, sub 5%, and you're now below it. You hit your head on it this morning. And that's kind of what the S&P 500 looks like, trying to get back into this range. Where's a logical spot where the market could come down? Here's the 21-day undercut and rally. I think it would make sense if the S&P, which is driven by some big tech companies, comes all the way down to that 760 range, chops around. This is where support from April comes in, and this is where a logical place for it to consolidate. Could it then run higher? Very probable. You're on a gas signal. The proof is there. You don't have that green arrow of confirmation anymore, so there is a higher probability it goes sideways or pulls down more than it ripping higher. So I hope that helps. The NASDAQ ETF, 1Q, whether you look at the QQQ or 1Q, this is all of the NASDAQ. Similar gas signal consolidation underneath the 21-day EMA, above the 50-day simple. Could it come down and test that 100 level on this particular ticker? That's possible. You're in this range. So I'd expect chop on large tech. Small caps are testing long-term support from April. You had some momentum that faded, and this is a logical spot where it got caught in congestion. And the international stocks are the only ones that have that green confirmation. It filled this gap, which is really nice to see. A lot of this is dependent on the US dollar, and it's chopping. And I would expect you to kind of at some point either kind of move a little bit higher to test this upper band where it seems to want to keep going to as a magnet. So whether you look at a cup with a bit of a handle, that's pretty fair. So, Mike, any comments on SPY, Qs, small caps, which creates our stock market score, or do you want to cover the gears or any comments?
Yeah. So that leads to our stock market score of a 9. It was an 8 yesterday, so we ticked up a wee bit today with the latest market action. And last Friday it was a 10. So I think the stock market score kind of sums up a little bit of the choppiness we've seen over the last week. And then just hitting the other gauges, percent invested as of this morning with today's move. And we'll talk about this week's move in a couple of minutes. But we're 100% invested. Our beta is right around a 1. And I think we do need to update that data a little bit, Scott, on the beta. I wouldn't be surprised, especially with today's move, if it went down a little bit. But yeah, let's call it around a 1. Portfolio heat is at a 5.2, so we ticked up a wee bit with the exposure we added. And for those of you who are new to what we do, portfolio heat is basically our estimate of what our portfolio would lose if all of our stops got hit over the next couple of trading days. It's a pure estimate, but we estimate it being about 5%. We watch that closely because if it does head up towards the red zone, up over, let's call it 7-8%, that's when we start to get really worried and take a hard look at risk more than we normally do anyway. So those are the gauges. Scott, you want to talk about the sector strength and the top 15?
Yeah, so the past 2 weeks, to the right is extreme strength, to the left is real weakness. If we just glaringly looking at it, it's a lot of green still, which tells you the market's still relatively healthy. Bitcoin has made a beeline to the right. Same goes for gold, healthcare, materials. So this is where your strength is. You're seeing things like financials take a break, which is we've cut some financials from our holdings. We'll share that with you. You'll see some Not as hot areas like utilities, industrials are on a break. I mean, not a break, but like just pausing. And the NASDAQ and small caps are not doing as well at the moment. So we're holding what we have as long as we can is on break on gas signals. And then down below the mega caps, you had energy and some software and healthcare move to the right, which has done really well. Tesla's having a good day today, which is really nice to see. That was kind of a laggard in the consumer discretionary sector. You still have Coase on Google, Berkshire, AMD. You have Broadcom, who was trying to raise some money today, and Meta and Walmart are in the doghouse. So I hope that's helpful. Anything you'd share from the chat, or what should we go next?
Yeah, we've got a couple of really good trading view questions. Would you like to address those now, Scott, or do you want to look at charts first and then we'll go to the trading view
Yeah,
questions?
let's fire on the questions first.
Okay, the first one's from Dennis as a new member, and after listening to last week's call for the first time, I thought I saw something on boxes as an indicator on trading view, but I can't find it. I thought it looked interesting. Can you tell me how to find it? And is there something similar on TrendSpider? So, Scott, I'll let you talk about the boxes, but we do not have our indicator on TrendSpider. It's on TradingView, and that's where we live. But yeah, if you want to talk about the boxes, Scott, I'd appreciate it.
Absolutely. So we issued 2.0, which had a couple of items that we wanted to do. So you go to Start Here, Rules and Tools, or Invest with Rules / ticker tool. Here it is. You can open a free TradingView account. They will do their best to have you pay them. And if you ever do pay them and you want more bells and whistles, they have a sale all the time, steep discounts.
Yeah.
So if you do not, you'd be shocked if you're paying full price for this solution. You click on this indicator and you just hit add to chart. So that's how you do it. We don't have Trend Spider. Onto the boxes. So the beauty of this, it has the background, which is the trend roadmap, the green, the yellow, the pink, the blue. We have these interfractal momentum indicators, which help us. So we're doing this selfishly. We hope it helps you. So you'll see all these green positive momentum indicators, and today's your breakout. And you'll see some red negative momentum indicators. If you double click on the red arrow or the green arrow, it will open up the item, and you say show boxes. So sometimes I think it's a little noisy, but what the beauty is, this is why I like the boxes, is if you go to the S&P 500, even though you were on a coast on March 31st and you felt terrible on the 30th, something's different, and these boxes help you say, hey, get ready, or start small. And this is where the clear gas signal with positive momentum is, but you can kind of see where this box lives. And I think there's no perfect science to it. We haven't had the ability to test the bottom of the box, but this would be kind of where you'd put your stop. Again, manage to where your own risk tolerance would be, but this is the most you're willing to tolerate. And so you put your stop here, and this is where you're out. So where I'm pointing my mouse, and now you've been in this choppy area and you broke it again. And now this is different. You're in a green confirmed box that never got broken, and now you're chopping around. But that's kind of the beauty of the box is double click and you could hide the boxes or keep them totally your call. Yeah. Any comments on that, Mike?
Yeah, and just to be clear, the boxes, the green box starts when you have your first new green momentum arrow that Scott's been pointing out, and that green box ends with the first red down arrow, and that's when a red box starts. And so that's kind of how it works. And if it's useful, fantastic. If you don't really get a lot of use out of it, then just like Scott showed, just click it off. And in fact, it comes default off. So just leave it off if you don't like it.
Yeah, so here's gold. So here's where the box started on a U-turn. So start small, you can add, now you got your gas. Um, so I hope that's helpful.
So let's see, Jason had a question, which I think you answered. Can you take a quick minute to show how to upload the latest update to TradingView? Yeah. So Jason, Scott showed you how to do that just a couple minutes ago. So if that's an outstanding question, please let us know, Jason. But otherwise, I think you should be good. All right,
Well,
let's look at some charts.
yeah, so we'll go to our new ads. So whether IAU or GLDM, we gave a whole bunch of tickers. It's totally your call which one you pick. We had one in our database. Just for the noise factor, I'll take it off just for now. So we did add gold on a gas signal and continues higher. You're now over the 200-day simple. So definitely a change in guard. We had such a great run in precious metals here. And this is a situation where it's coming back and we need to have exposure. We have a position in SIL for a while. We've had a position in COPEX for a while. Um, yeah, we're playing trends. So that was one. And let's just do one more since we're on it this morning. We've talked about FCX. Sorry if my line is not perfectly there, but the funds are here on FCX, Freeport-McMoRan. They're copper, gold miner. The trend is there, and this is actually sometimes our algorithm. So this is based on relative strength, one is based on rate of change 14. Both of our models are in this. And this morning it's climbed even higher where now it's on an overheat. Depends, but overheat to us means an RSI of 68 or greater. So could it do some chopping around? But this has been a very long consolidation. So since January, moving sideways, so forming what I would dare say, let's see if I can draw it really quickly for you. Let's do a arc. Let's do that. That's fun. So come on, computer. Let's do an arc and let's draw it. So I think one could dare say this is a maybe a cup and handle. But that's kind of what it looks like to us. We're following our system. If you're using like a system like Investors Business Daily, there's your kind of confirmation system where you have short-term, long-term uptrend. This morning, that's where we got in. If your system says that you're okay to buy below 70, then the coast is still clear. And who knows? This is a situation where you had a breakout similarly over here, um, and it made a huge run. And this is a normal consolidation. So we'll share FCX. And then we'll look at Natera, and then I'll pause, is gas signal. This was a gap up. We were able to get in before the overheat happened, and testing company in the healthcare space. Funds are here, trend is here. I mean, in a perfect world, we'd be buying over in here, but this is part of the system. Sometimes, even though it's not the most comfortable, you take the trade and you manage the risk. And this so far has been consolidating that gap up after earnings quite nicely. Mike, any thoughts on anything I just covered?
No, I've had some connectivity issues, so you may have already did this, but did you cover Bitcoin?
We talked about it. Let's talk about it some more. So, Bitcoin's on a U-turn. So, it's after a disaster. You get this blue region. So, here's IBIT, which is one of the larger ETFs. There's other ones out there. And this has been an awful situation starting here. So, November of 2025, when you got your break signal, it has lost 40 plus percent of its value, very .com like or S&P like in the .com time frame. And you're getting another one of these big U-turn runs with green confirmation. So if one wanted to start small, the major difference is the volume pattern looks different because this is going through possibly Congress to do more around crypto. So you'll see U-turn with a confirmation, U-turn with a confirmation, 3 days. Now you're on overheat. So my expectation is you bang your head up against this 44 to 46 range and you consolidate. And then the question from that point on is, do you climb higher or do you fill these gaps, come down a little bit more? My expectation is that you probably would come down. One company that we do own in Fastlane, which is having a nice day today. On our billion-dollar fund manager list is Figure, which is chain. They do lending as well. So think if you're going to do a HELOC, a loan off your house equity value, this is a super fast way to do it. The funds have been here. They like the concept. We were in earlier, but gas signal, now you're on gas on overheat. But this is an example of a stock up like 8% today. And you're now finally over the brand new 200-day simple moving average after IPO. So choppy IPO, but whenever an IPO does something kind of rips, you're on our radar. So I hope that's helpful for our
Hey,
Bitcoin
what?
friends.
Yeah, while you're at it, Steven asked us to look at Block, BLOK. Let's look at that in this space too.
So Block, let's do Block Holdings, Amplify ETFs. It owns Figure, its top holding. Galaxy, Robinhood is on our list, on our watch list this morning. Cypher, Opera, that's a fun one. Hut. So some of these are data centers, compute power as well. So let's go back to Block. This one is second day gas signal with confirmation. You had a gas signal here, but it faded. I think this looks great. I think you could draw a trend line here, and that's probably where you're going. But I don't have a crystal ball, but that's what the trend is telling me.
Okay, excellent. All right, so there you go, Steven. There's Block for you. Would you like to take a look at other charts or go to tickers that have been requested, Scott?
Let's do some ticker requests. Love it. I hope you have a wonderful Friday and weekend. Hope this is helpful. We hope this research really helps you identify the trend, helps you follow big money, helps you manage risk. We would love to for this to help you with these tougher decisions. So again, you can sleep at night knowing you have a system that can try to navigate a lot of the torture of a dot-com scenario if it comes again. Have a wonderful day, weekend. Talk soon. I hope this helped you identify some uptrends or things coming to uptrends, but please always do your due diligence, manage your risk tolerance. This is not a direct solicitation, just things for your watch list. I hope it was helpful, and I'll see you at investwithrules.com.